Emily Chang, and this is Bloomberg Technology. Coming up, the NASDAQ 100's worst drop in 3 months, and the U.S. tax overhaul could be to blame. We'll explain the tech tumble. Plus, Uber board member Arianna Huffington's take on Uber's cultural U-turn and sexual harassment from Silicon Valley to Washington. And GM's self-driving car, our test ride in the Chevy Bolt, and my conversation with GM President Dan Ammann. First, to our lead. Tech stocks were caught in a massive sell-off in Wednesday's U.S. trading session. While the Dow hit a new record, tech shares tumbled more than 1%, its biggest decline in 3 months. Bloomberg News stocks reporter Abigail Doolittle joins us now from New York with more. So, Abigail, how common is this kind of divergence that we're seeing in the U.S. majors?
You know, Emily, I don't really remember something of this degree in quite some time. Today's trading session was really pretty interesting. As you mentioned, the Dow finishing higher by more than 0.4%, putting in yet another all-time high. The S&P 500, in fact, finished down fractionally, but that index also put in an all-time high. But the NASDAQ, that tech-heavy NASDAQ, finishing down about 1.3%, as you mentioned, the worst day since August. So to have that degree of a divergence between old economy stocks, if you will, in the Dow, a mixture in the S&P 500 and the new economy stocks in the NASDAQ really taking a hit. Not surprisingly, the FANGs really going down. Facebook, Amazon, Netflix, Alphabet, all of those stocks down more than 2%. In fact, at one point, those stocks were on pace for their worst day as a group since 2014. That's how bad the selling was. Chip stocks also taking a big tumble. The SOX, that Philadelphia Semiconductor Index, at one point down more than 5%, on pace for its worst day since the Brexit. But it did actually finish down more than 4%, its worst day of the year. And lots of stocks behind that, and perhaps the trigger to the overall tech sell-off. There was an analyst over at Morgan Stanley earlier this week. Her name is Katie Huberty, who put out a note talking about peak NAND. That's a specific type of storage used by chips, or a type of storage for chips. And she's saying that we might see the first downdraft since 2016. The SOX, of course, Emily, up in a huge way over the last year. So investors wondering if we're overextended. In fact, if we hop into the Bloomberg, we have a great way to put this into perspective. This is #BTV 8808. Of course, all of the major averages have put in all-time highs, but this SOX has yet to hit its 2000 peak, just inches, moments, and points away from it. And if the SOX loses momentum here, perhaps that won't happen. Considered to be a leading indicator, a leading index, considering that chips are used in pretty much everything that we need. So if the demand lessens there, perhaps a sense that maybe the economy is not growing as fast as some people seem to think. That would be contrary to pretty much everything else we're seeing, but it is a concern that the SOX is weak.
So what kind of volatility are we expecting?
That's an interesting question, Emily, because relative to the S&P 500 VIX, we've been hearing about all-time lows, record lows, below 11, finishing today, I think, close to 10.7 or so. But the VIX for the NASDAQ 100, not surprising, shooting sky high. We have another really good terminal here to take a look at this. This is #BTV 3506. And what we're looking at here, Emily, a long-term chart of the VXN, or the NASDAQ 100 VIX, relative to the S&P 500 VIX. And we see that the NASDAQ, the tech VIX, is shooting sky high relative to the regular VIX. This was true, too, back in June. If you remember, Emily, back in June, we had that mysterious tech sell-off out of nowhere. Today's sell-off is reminiscent of that. People are talking about different potential triggers, as you were mentioning, the tax overhaul. Tech companies have lower taxes. Could this perhaps be disrupted for them? Perhaps that chip call. But it's really not clear. There's this sector, to some degree, technology may be overextended, so some profit taking here. But if you start to have this kind of volatility in the tech sector, perhaps it leaks into the broader markets overall. Certainly an interesting tell to keep an eye on, and we will certainly be reporting on it, Emily, in the days and weeks ahead. If it continues, it may not. It may just turn out to be a one-day blip.
All right, we'll be watching you. Abigail Doolittle, thanks so much. A story we are watching: Nokia is said to be in talks to buy Juniper Networks. This according to CNBC. The offer would value Juniper at around $16 billion. Juniper shares spiking as high as 21% in late trading. Meantime, Bitcoin continues to hold the attention of investors around the world. It surpassed $11,000 in a matter of hours after hitting the $10,000 milestone, but then climbed back down that mark on increased warnings that the largest digital currency is in an asset bubble. And institutions are jumping into this asset bubble. The NASDAQ plans to introduce Bitcoin futures next year, becoming the third major U.S. exchange to attempt to dive into the red-hot market for cryptocurrencies. Coming up, Thrive Global CEO Arianna Huffington talks about raising money for the startup, Uber's cultural turnaround, and the sexual harassment scandals rocking tech, the media, and Washington. This is Bloomberg. Uber's losses grew bigger in the third quarter. According to people familiar with the matter, the ride-hailing service lost almost $1.5 billion in the period. The world's biggest startup is trying to fend off competition globally. Plus, it is facing more legal challenges and regulatory scrutiny. Meantime, Uber board member and Thrive Global CEO defended the company, saying it conducted a full investigation into its recent high-profile hack, and she's happy with CEO Dara Khosrowshahi. We talked about Uber plus the wave of sexual harassment scandals in tech and media in a wide-ranging interview. Huffington was joined by Samesh Dash, IVP General Partner, and we began our discussion on the latest $30 million funding round at Thrive, led by IVP, and the next phase for the startup.
We spent the first year with multiple clients around the world, refining our IP, our behavior change, pathways, micro steps, and now with this new funding, we'll be able to productize it, to actually create digital, science-based behavior change offerings, both for corporations around the world and for consumers, to help them reduce the stress and burnout in their lives while improving their productivity. I think at the heart of Thrive Global is this fact, which is entirely science-based, that our well-being and our performance are tied together. They rise and fall together, and when companies realize that, they will continue to accelerate their investment in their human capital, because that has immediate and verifiable impact on the bottom line.
Samesh, you're joining the board of Thrive. IVP has also invested in Twitter, in Snap, in Slack. What do you see in a company like Thrive, besides the founder being Arianna Huffington?
Well, thanks for having me, Emily. I think the big thing we look for is evidence of product market fit and hypergrowth. And what was amazing is when we looked at Thrive compared to other enterprise-focused companies that we'd invest in, including SuccessFactors, Domo, and others of those sort, Thrive's first year is out the gate in terms of customer adoption, revenue growth were phenomenal in the top quartile of all deals that we've done, and much far above what we typically look at. And beyond that, I think we sort of look for in enterprise businesses evidence of land, expand, renew, and refer. So they were landing big customers with actually sizable contracts, even before they had a fully fledged sales force when they were experimenting. They were renewing those contracts before those contracts were even due. They were expanding into different departments and different use cases. And then the best part that we really look for is the customer referring this product, this service over to other people in the industry? Because people in human capital know each other very well, and it's a small, close-knit community.
Arianna, you're trying to do something very difficult, which is change behavior. What kind of change are you actually seeing, and how much more work is there to be done?
Emily, there is a lot of work to be done, but what is exciting is that we're at a tipping point, that more and more individuals and more companies are realizing that we have been living under this delusion that in order to succeed, you have to burn out. So what we've done, as well as our B2B offerings, we've created a media platform which takes everything I've learned from 12 years at the Huffington Post and basically brings together the latest science that proves unequivocally that in fact, when we take care of ourselves, when we put our own oxygen mask on first, we are more effective at work. And also new role models, people in the arena, very successful people like Jeff Bezos and Richard Branson and Eric Schmidt and Sheryl Sandberg, writing about how they prioritize their own well-being, and that makes them better at work. Jeff Bezos, for example, wrote a piece that went crazy viral, and the headline was, "Why am I getting 8 hours of sleep is good for Amazon shareholders?" And he actually broke it down that when he got only 6 hours sleep, his decisions, he wrote, were not as good. And as he put it, my value is not in the amount of decisions I make, but in the quality of decisions. So people want that reinforcement, that permission, if you want, that goes against a lot of our mainstream culture, which still valorizes people who are always on, who never recharge, and ignores the data that has a very negative impact on business metrics.
Samesh, when it comes to entrepreneurs, your funding, and the way you communicate with your portfolio companies, how do you deal with these kinds of issues?
Well, it's become a real issue, as Arianna said, Emily. I mean, when we see hypergrowth companies, what we're attracted to is just the breakneck speed at which they're executing. But what she's referring to is absolutely the case, where we've seen a number of our portfolio companies, people burning out. When they're doing exit interviews, we have the chance to sometimes see their feedback. And the feedback is, I wish I had a chance to build more deeper relationships with my coworkers. I wish I had a time to actually process some of the things that I'm building and learning about. So I think what we really are at is this tipping point in our culture where healthcare costs have skyrocketed in this country. And today it's not a fringe HR discussion. This is a CEO level discussion about saying, how do we attract, retain, and actually replenish our workforce, where we have amazing people that want to come to work excited about the day ahead and leave fulfilled. And I think that's the opportunity that Arianna is bringing content towards addressing.
Speaking about another potential tipping point, I have to ask you guys about the continued sexual harassment and discrimination allegations that are impacting not just tech, but the media industry, politics. Matt Lauer was just fired from NBC. Charlie Rose fired from CBS. Bloomberg has ended its production and distribution arrangement with Charlie Rose. Arianna, as a media mogul yourself, how big a blow is this to these franchises, and how do they recover from what seems to be very bad behavior by very powerful men?
Well, what we are seeing, Emily, is all these companies moving very fast, making decisions very fast, ending contracts very fast. And this is an indication of the cultural moment we are in, a cultural moment truly of zero tolerance, where behavior that has been quietly accepted for decades is no longer accepted. It's a very, very important moment, and it's a moment which is going to make it much easier for women to flourish in workplaces and to rise in workplaces, because again and again we've seen how prevalent sexism has made it much harder for women to have sustainable careers in many businesses, whether media, entertainment, or anywhere else.
So, you know, when it comes to Washington, Senator Al Franken, Arianna, I know some photos of you and him surfaced. There continues to be this question of where do we draw the line, and you've defended him. Why?
Well, Emily, the pictures of Al and me were an extension of a comedic sketch that he and I did probably before you were born, called Strange Bedfellows. So they were an extension of a comedy sketch. I think they trivialize the real pain and the real anguish of women who have been groped and harassed. And so it's not about defending Al, it's about making it clear what us joking around during a photo shoot about a comedic sketch were about.
Arianna, you've been part of what everyone seems to hope is a major cultural transformation at Uber, and yet the bad news continues to come out. Now there's this massive hack attack that the company covered up. You know, when did the board learn about that, and what's your sort of sense of when the bad news will stop?
Well, when the board learned about it after Dara became CEO, we did a full investigation, and as soon as we had the results of the investigation, Dara announced it to the public. I think we are very lucky to have a CEO who is both unflappable and willing to make big, bold bets into the future.
Uber's still facing 5 various probes, and I'm wondering if you worry at all about being on the board yourself. You know, you joined before there was any real significant bad news. Do you feel like you were misled by Travis Kalanick?
No, I never feel I was misled. And I think what is interesting now, today, for example, looking back at the testimonies this week around Waymo, we remain very confident of our facts in this case. Nothing in this week's testimonies that have been in the news has changed that fact. As you know, the SoftBank tender has been launched. We are very happy about that. So there are a lot of good news and a lot of, as you said at the beginning, Emily, proof points of the cultural transformation. Dara announced the new cultural values, which no longer include some of the old cultural values, like being always on, like working smarter, longer, harder was also an Uber cultural value. No more. Doing the right thing, period, is now a cultural value. So we're very excited about all the amazing changes that have been happening over the last 2 months.
That was Uber board member and Thrive Global CEO Arianna Huffington, along with Samesh Dash, IVP General Partner. Coming up, more shakeups come to cable news' biggest name in sports. Can ESPN navigate the changing sports media landscape? This is Bloomberg. Alibaba is planning a $7 billion bond offering. This would be the largest U.S. dollar bond sale by an Asian corporate issuer this year. The Chinese e-commerce giant plans to offer the notes in 5 parts. Maturities will range from 5.5 to 40 years. The deal would eclipse the $6.6 billion offering from China Evergrande in June. Well, it's another day of bad news for ESPN. For the second time this year, the self-proclaimed worldwide leader in sports is firing staffers. This time, it's about 150 people, or 2% of its workforce. The Disney-owned sports network continues to struggle with losing subscribers, mounting costs, and a string of social media setbacks. Bloomberg media and entertainment reporter Lucas Shaw joins us now from LA, and in New York, our editor-at-large, Corey Johnson. So, Corey, I'll start with you. Obviously, this is something we've been continuing to cover. Right. Now, you know, another slate of bad news. What does it mean?
Well, I think what it means is, if we want to take a macro view of it, we can see the difficulty that ESPN has had dealing with the internet. Some of the things that ESPN has done on the internet and done with new technology has been very strong, and their websites are part of that. But fundamentally, a shift away from watching linear television on cable or anywhere else has been a problem for ESPN. ESPN seems to have had trouble adapting to a post-Sports Center world and finding the right editorial model to keep viewers with them.
So, Lucas, what do we know about these particular layoffs, where they'll be coming from, and how they'll hit the network?
Most of the people losing their jobs are going to be people that no common person has ever heard of. They are people who work in operations and technology. Kind of to Corey's point, one of the interesting things is that some of the people losing their jobs did have some technology background. It was just in the wrong kind of technology or doing something that ESPN no longer deems necessary. And ESPN is now going to shift resources into a few new areas like the streaming service that they're hoping to introduce next year, as well as a new morning show that's supposed to debut in the spring.
Corey, what does it mean for Disney?
Well, the cash cow that has been ESPN has allowed Disney to do a lot of other really interesting and exciting things. It's also helped fuel a very successful acquisition machine. So it is still a great cash cow for them, but not what it had been. And the growth numbers aren't there. If you look at the revenue numbers from the cable division, most of which is ESPN, if you look at the subscriber growth numbers that we model on the Bloomberg terminal, and you can see those, you see the subscriber growth numbers have been down. They're not dramatic, but it's a change in direction. And that change is dramatic and a problem for ESPN. And once again, I think it does come back to the programming. You look at what they've done with certain shows. You look at Stephen A. Smith in the morning with his wonderful ability to scream at the TV, and the guest host across from him in Max Kellerman right now. And there are attempts to sort of mimic that throughout the day. You look at the great editorial success that PTI has been in the afternoons for them, and there are attempts to mimic that around. But what you don't see is the kind of numbers drawn towards that. You've also seen the rights for sports sports. The cost of that increased so dramatically for ESPN. It's also interesting to look at the role of sports in our culture, and that in a monoculture that once existed, we had a handful of networks, and you had everyone listening to the same kind of music of a certain generation. You don't have that anymore. And the question is, politics starts to loom large because everyone has the same kind of politics, and you can't really select your own way around that. But on the internet and mobile communications, you can pick the different kinds of culture you want. The question is, can sports maintain a sort of singular monoculture that draws a lot of people under the same giant tent pole going forward as it has in the past? And I think that's an open question right now.
Lucas, what is ESPN's proposed escape route here? How do they plan to attempt to adapt to the new media landscape?
They're playing a very difficult balancing act because the real money for ESPN is still and will be for a very long time, or at least for a little while, in the traditional pay TV business. They get paid several dollars per subscriber. They have tens of millions of subscribers, billions of dollars in revenue, and they can't anger their pay TV distributors too much. So like this streaming service that they have coming hopefully for them next year, they're not going to be able to offer, or at least they're choosing not to offer, some of the biggest games. You're not going to watch Monday Night Football on that service. You're not going to watch the NBA Finals on that service. And that is a potential problem for them because they're trying to grow a big online service to compete with these new competitors and preserve what they have.
Lucas Shaw for us there in Hollywood. Corey Johnson, our editor-at-large. Thank you both. Obviously, we'll continue to follow. Coming up, we're talking GM taking its self-driving flagship car out of the showroom and onto the streets. I got a ride. We'll give you a look. This is Bloomberg.
I'm Elisa Parenti in Washington, and you're watching Bloomberg Technology. Let's start with a check of your first word news. President Trump was in Missouri today pitching the GOP-crafted tax plan.
If they send it to my desk, I promise all of the people in this room, my friends, so many friends in this room, it's a great state. I promise you I will sign it. I promise. I will not veto that bill.
It's the president's second visit to the state to sell his plan. He also dismissed claims from Democrats that it mostly benefits the rich. The EU's chief Brexit negotiator, Michel Barnier, hopes he reaches an agreement on a financial settlement before an EU summit in mid-December. Barnier spoke today in Berlin, dismissing reports that both sides had tentatively agreed on a divorce bill of about $59 billion. He said Britain had chosen to return to being on their own rather than standing in solidarity. A spokesman for the UN's War Crimes Court confirmed that a former Bosnian Croatian general died in a Dutch hospital shortly after drinking liquid in a courtroom. Despite efforts to save him, judges had just confirmed his 20-year sentence. Israel has launched a program to provide shuttle service for people in the Gaza area looking to travel to the U.S. consulate in Jerusalem. Tel Aviv recently barred trips for visa interviews after some applicants reportedly fled into hiding in Israel and the West Bank in attempts to find work. And China's premier says the trade turnover between China and Russia has jumped 20%. He spoke at a meeting in Moscow with President Vladimir Putin. Putin praised what he calls the stable contact between both countries. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Elisa Parenti. This is Bloomberg. It's just after 5:30 p.m. here in Washington. Already 6:30 Thursday morning in Hong Kong. We are joined by Bloomberg's Sophie Kamarudin. She's got a look at the markets. Sophie, good morning.
Good morning, Elisa. Well, following that tech tumble in the U.S., we could see that FANG flu continue in Asia, where the tech sector has been under pressure all week. Plus, we have Asia's factories in focus with Chinese PMI and industrial output due this Thursday from Japan and South Korea. And for Korean investors, aside from that, plus that tech rout and Pyongyang-related risks, they will be watching the central bank for an anticipated rate hike at its policy meeting. Futures in Tokyo, though, pointing higher ahead of what could be a busy session. Now, flipping the board to check in on the dollar, we are seeing that trend just slightly higher here, while the yen is flat after a choppy trade. And Bitcoin having a wild day. We do have gold, though, just trading flat right there. Oil continuing to slip as risks are skewed to the downside, with an OPEC output cut extension largely priced in Hong Kong. I'm Sophie Kamarudin. Up next, more Bloomberg Technology.
This is Bloomberg Technology. I'm Emily Chang. General Motors is finally letting its self-driving cars out on the streets of San Francisco. This week, Chevrolet unveiled its autonomous vehicle, the Bolt, which is powered by technology from Cruise. We got a chance to take it for a hands-free ride, or should I say, it took me on a ride.
So we're waiting for our car. The name of our car is Pickle. We're going to take a drive to the bay. Pickle is here. All right, let's do this. All right, we made it. Okay. We covered 2.4 miles, drove past 178 people, 9 bikes, and 148 cars. Definitely a little jerky, some stopping and starting at times. You could sense the car, trying to figure out what people were going to do. Were they kids playing with a ball? Were they construction workers who weren't going to move? But I'm in for round 2. I think it'll get better next time.
Now, right after that ride, I sat down with General Motors President Dan Ammann to see just why they decided to let us ride in a self-driving car that isn't quite ready for consumer launch just yet. Take a listen.
Our objective is to deploy these cars in the most complex environments. That's why we're testing and demonstrating here in San Francisco. We want to deploy with scale, and we want to deploy with a really high level of safety. So that's what we're marching towards. We've been moving at a really fast rate of development. That's why we wanted to give people like you an opportunity to experience the cars today, again, operating in this really, really complex environment. So we're moving quickly. We're heading towards commercial deployment in some quarters away from now. And we're really excited about the rate of progress.
Some quarters, how many quarters?
Some number of quarters. Quarters, not years.
Okay. So my ride experience was fascinating. Definitely some stopping and starting. I understand it's a complex environment. You know, there were a couple of times where, you know, it tried to merge, but then there was a car there when we jerked back in. There was a time we pulled up to some kids crossing a crosswalk, and you could see the car realizing, oh, this is a long line of children, not just 1 or 2, but it got a little confused. How long will it take to smooth over those kinds of issues? So
safety is absolutely the #1 priority. And so part of the experience you would have noticed today is that the car is relatively cautious. But again, that's all about safety. And safety will be the defining metric that tells us when we're ready to actually deploy these cars. We're moving really quickly in terms of continued performance improvement, and that's why we want to give people an opportunity to experience the cars today. And then, you know, some number of months from now, people can get another read on where we are and see the rate of change.
You know, how do you decide when you're at a point where this car would make the same decision that a human driver would?
Well, that's really what we're aiming for. We understand pretty well human driver level of performance, and we want to make sure that we can deliver that same level of performance and, frankly, better over time.
There's still a steering wheel. There are still pedals, still a safety driver. How far away are you from a car without a wheel, without pedals?
Well, it's back to this, you know, what needs to be true to launch commercially, and that's getting the right level of safety performance. And as soon as we get to that level in time, we'll be able to pull the driver out of the car, the safety driver out of the car, and that will afford us an opportunity to rethink what the car might look like.
What about affordability? Are they even close to being affordable, even for fleet companies?
Well, one of the reasons that we think a rideshare environment is the logical place to deploy these cars is we can get a really high rate of utilization on them. So even in the early days when the cars are expensive and the sensor technology is expensive, we'll still have a really compelling business case and still be able to offer rides at a more affordable rate than where human drivers are at today.
Can you give us an idea of how much it costs to make one now?
I could, but I'm not going to give you a number.
Okay. So then what is the strategy to bring these to market?
So again, first thing is to get to the level of performance that we want to have. And once we're at that point in time, we see the logical first mode of deployment being into a shared network in a complex environment, urban environment. So a rideshare type model.
You've partnered with Lyft. You've made a big strategic investment with Lyft. You also have an agreement with Uber to rent them a small number of cars. Whose side are you on?
So our objective, again, is to get this technology deployed in the largest scale possible with the right level of safety. As we think about how we ultimately do that, we could have one partner. We could have more than one partner. We could potentially have no partners at all.
What do you think you'll have? I mean, what looks like the most plausible scenario for you? How do you work through those scenarios?
I'd say at this point in time, all options remain open. As we get closer and closer to commercial launch, that those plans will begin to crystallize.
Now, we see the iterations of the various cars here. Looking towards the next iteration, how do you get the equipment smaller and sleeker? How do you make it look more like just another car on the road?
So what we're doing here is we're iterating at an unprecedented pace. So you see 3 generations of car here. We're working on a 4th generation right now. All of that's happened in less than 18 months, which is a really rapid hardware iteration cycle. And we're going to continue those iterations, as we get closer to and through commercial launch, and frankly afterwards as well. So we're going to keep that moving.
How critical is the LiDAR technology, and is it possible to have self-driving cars without it?
Right now, we think LiDAR is a really important part of the equation. What we've been working on, we made an acquisition just recently, is getting the cost of the LiDAR sensors down dramatically. We think we can reduce that by almost 99% from where we are today to where we could be in the relatively near future, to get the performance up and to get the reliability up. And we think with that combination of characteristics, we're going to have a really compelling multi-layer sensor suite.
One of the most rewarding parts of the experience, I thought, was being able to see the app, see the car, see cars on the road, people on the road, and the objects moving across the screen. How does that all come together?
So the car is obviously evaluating everything that's going on around it at a point in time, and it's making predictions as to what all of those different sort of characters are going to do, and then it plans its path around that. And so what you saw was a representation of what the car is seeing and how it's thinking about that environment.
Is that based on Cruise, or is that other technology?
That's all internally developed technology.
All internally developed technology. So when it comes to Cruise, is Cruise doing all of its high-definition maps in-house? And if so, how does it differentiate itself from competitors?
So what we're doing is making sure that we control all of those pieces of the total system that we need to move as quickly as we can. So we're doing a lot of our own mapping work. We're doing, obviously all of our own self-driving software and a lot of work on the hardware side. So we want to keep iterating the entire system as quickly as we can, and by controlling all of those pieces, it enables us to move more quickly.
Can you give us an update on sales of the Chevy Bolt in general?
Chevy Bolt sales have been going really well. We had a record month last month. We expect to have another record month this month. We're feeling really good about the trajectory.
So a year from now, where will GM's self-driving efforts be?
We will be, I think, in a pretty interesting position a year from now, and we look forward to keeping you updated on that.
What's been your most interesting experience in a self-driving car?
It's really just been to see the rate of progress that we've been making. So it's been really exciting over the last 18 months from the time that we acquired Cruise, the rate of change to where we are today, able to share that with you and others, to get a sense for where we are, and with a pretty clear line of sight on getting to the point where we can launch this commercially.
Would you take your family on a road trip in this yet?
We've still got development work to go, but ultimately that's the objective.
GM President Dan Ammann there on his company's self-driving car, the Bolt. Well, the innovator behind Google's Android mobile platform left the company in 2014, but it is now coming to light that Andy Rubin departed after an accusation of inappropriate behavior. This according to a person familiar with the matter. The information first reported about Google's internal investigation into Rubin's conduct. Rubin has now taken a leave from his consumer hardware startup Essential. He told the board he needed time off to deal with personal matters. Coming up, Snap is making new attempts to attract more users and advertisers. Details on the changes made to the mobile app next. This is Bloomberg. A technical glitch may leave American Airlines without any pilots over the holidays. The scheduling flaw has left more than 15,000 flights without sufficient crew during the next month or so. The airline says the problem should be corrected in time to prevent service disruptions. It's also offering pilots 1.5 times their normal hourly wage to pick up some of the flights. However, the union representing the pilots has filed a grievance, saying the proposed solution violates its labor pact. Well, after disappointing sales over the last 3 quarters, Snap is redesigning its photo sharing app to attract more users and advertisers. The company says a simpler design will encourage people to spend more time on Snapchat. The biggest change, separating photos and videos sent to users by their friends from content produced by media companies. Joining us now, Bloomberg Tech's Sarah Fryer, who covers all things Snap. So why did it take them so long to realize they needed a redesign?
Well, the company is coming out now after a lot of what they see as misunderstanding by the public about how Snap works and how it can grow. And Evan Spiegel is touting this redesign as a departure from how we think about social media in terms of how Facebook produces it, where your friends drive you to the media content, they share it, whatever's popular rises to the top. And Evan wants to build something that has a little bit more of a Netflix personalized aspect to it, where you see the content that you want to watch based on what you've seen before. This is something that they won't say what caused them to go through this, but clearly at the last quarter, third quarter of disappointing revenue, they needed to give some hope for the future.
So will this do what they wanted to do, which is attract more users and attract more advertisers?
I'm not sure yet. What we have here, the separation of the social and the media, the biggest challenge here is that now you don't have friends directing people to the media content. The media content needs to be compelling enough on its own to drive that attention, to get people to see those ads. And otherwise, you could just use Snap and only talk to your friends and see your friends' stories, and that would be just fine. So Snap really needs to prove that quality means more than popularity in terms of what users want. It could turn out to be something amazing, like everyone loves Netflix, right? But it could also turn out to be something like Twitter's Discover tab, which shut down, right? It could be good or it could be awful.
Snap did say in a blog post, until now, social media has always mixed photos and videos from your friends with content from publishers and creators, while blurring the lines between professional content creators and your friends has been an interesting internet experiment. It has also produced some strange side effects, like fake news, and made us feel like we have to perform for our friends rather than just express ourselves. I mean, it is a good point.
And it's an obvious slam at Facebook. Yeah. And if you think about Snap's trajectory, they're really in the position to tease Facebook in public like that. Facebook has been constantly copying Snap's most popular features. And here's Evan saying, like, well, you guys are kind of doing it wrong. You're kind of still not getting it. Like, this is how users want content to be displayed. And the question is not whether this is what users want. It might in fact be what they want, but whether it helps Snap deliver on its promises as a public company, getting that revenue visibility, getting that user growth that's going to take them into the future.
Big open question. Sarah Fryer, who covers Snap for us, thanks so much. Coming up, our sit down with TPG founding partner and co-CEO Jim Coulter about the company's bets on two of tech's most valuable startups, Uber and Airbnb. And tune in to Bloomberg Television for an exclusive interview with Lloyd Blankfein, Goldman Sachs chairman and CEO, and Michael Bloomberg, Bloomberg LP founder and majority owner. They'll be sitting down with our very own Alex Steele to talk about Goldman's 10,000 Small Businesses program and how they are taking it to Washington. That's this Thursday, 9 a.m. in New York, 2 p.m. in London, 10 p.m. in Hong Kong. This is Bloomberg. TPG, one of the largest private equity firms in the world, has investments in a wide range of sectors from retail to healthcare and China. But it is also an early investor in two of the most prominent tech startups, Uber and Airbnb. We sat down with Jim Coulter, co-CEO and founding partner, to ask how he sees the trajectory for those two companies playing out.
What we've tried to do is choose specific companies that have places in their industry that are special. And I think that's true of both Uber and Airbnb, Spotify, and Vice. So what interests me as an analog to Uber Eats at Airbnb is they're now beginning to focus on experiences. If you think about traveling to a hotel, you don't just want the room. You want the concierge, you want its exposure around the city. So I have been a big advocate of a general shift in the economy from things to experiences. And I'm really interested in how Uber is is building Uber Eats, but Airbnb is building its connection to experiences.
Uber surrendered in China. Airbnb is pushing forward in China. They are not the market leader there. Could you foresee doing a partnership with a local rival, like Tujia, for example?
And I wouldn't use the word surrender in China for Uber, is that partnerships and alliances are actually smart. So I think as anyone tries to expand at the rate these companies are, finding partnerships and alliances it's just smart business.
You guys are putting more money to work in content and entertainment than almost anyone when it comes to Vice or CAA. What's giving you the confidence to do that?
Over the top, the delivery of content when you want it is fundamentally changing one of the largest consumer industries out there. And we don't even know quite where it's going to end today. I mean, Game of Thrones would have been almost unimaginable a few years ago. And now we have a move from that content to short form. So the idea of content and content shifting is, to me, one of the most interesting things happening.
Are you at all worried that too much money is getting put into content? Are we in a TV bubble?
We're certainly increasing the number of scripted shows in TV very rapidly, and like most shifts, there will be moments where the pendulum will swing back and forth. So for me, I'm fascinated by the concept of binge watching. Binge watching, in my view, is just watching. It's just how people are going to watch in the future. And as that evolves, I think you're going to see the dollars being spent in TV really becoming some of the dominant dollars in content.
You're also investors in Spotify. What makes you think that Spotify can take on Apple in the long run?
Yeah, it's taking on Apple at any time is daunting, but Spotify, I think, has shown very rapid growth and effective positioning in doing that. I think one of the most interesting things about Spotify is its position as a data company. So its ability to evolve to meet the customer need. So I think it's will be one of the winners. I think we tend to believe there's going to be one winner in a lot of these industries. But generally, Spotify will clearly be one of the winners in the music business going forward, and maybe in adjacencies to music.
You brought in an outsider as a co-CEO. You're a founder yourself. That's a tricky proposition. How have you and John Winkelried split up responsibilities?
In the old days, when we were a simple business, we simply had to invest well. Now we have to invest to the highest standards, but we have to manage ourselves well. And so those skills of investing and managing are sometimes not resident in one person, and certainly take a broad set of efforts and personalities. My background's a little bit more as an investor, although I've been a manager for a long time. John's was a little bit more as a manager, although he'd been an investor, having Goldman Sachs' PIA division report to him. So it was really bringing the best of those two together.
You guys are going to start raising a new fund next year. We've heard the cap is as high as $13 billion. Can you share anything about your plans?
I think our goal is to have enough capital, but not too much.
TPG has remained private while your competitors are publicly traded, whether it's Blackstone or KKR or Carlyle. Do you think TPG will still go public someday? And if so, when? It's
totally unclear to me. I've had this question for 10 years, and for 10 years I've answered it the same way, which is we have no real desire to go public. And if you look at the...
But there were plans to go public, and those plans were shelved.
They were shelved, and the reason was we've constantly said we only will do it if we think we need to do it. And what's become clear to me is that those that have gone public are maybe not as pleased with being public as they might have anticipated. There is now capital available in the private markets for companies like TPG also. So why go public if you don't have to and don't particularly want to?
That was TPG founding partner and co-CEO Jim Coulter. Be sure to check out the full episode tonight at 9:30 Eastern on Bloomberg Studio 1.0. That does it for this edition of Bloomberg Technology. A reminder, we are live streaming on Twitter. Check us out at Bloomberg Tech TV weekdays, 5 p.m. in New York, 2 p.m. in San Francisco. That is all for now. This is Bloomberg.